All right, let's just jump right in. For the last couple of years, the story of AI has been all about one thing: spending. Just massive, mind-boggling spending. But we've hit an inflection point. It really feels like 2026 is the year the music starts to slow down, where the entire conversation shifts from how much can we spend to is any of this actually making money? The big question is no longer about building, it's about profit.
And just to get a sense of the scale we're talking about, look at this number. By 2026, the world is on track to spend $2.52 trillion on AI. I mean, just let that sink in. That's more than the entire economy of Canada or Italy. This isn't just another tech cycle. It's one of the biggest, fastest capital deployments in human history. And when you have that much cash flying around, you better believe the stakes are incredibly high.
And that quote really gets to the heart of what we're talking about today. The era of just writing blank checks for AI, well, it's coming to an end. After years of funneling hundreds of billions of dollars into chips and data centers, the people who write those checks are starting to ask some very pointed questions about the bottom line. This isn't just curiosity. It's an ultimatum for the entire industry.
So let's start by digging into this gap. We're going to unpack this massive disconnect between the money being invested and the money actually being earned. Because when you look at the numbers, the picture starts to get a little, well, concerning.
Now this is really fascinating. What you're seeing here is just a shocking disparity. On one side, you've got the tech giants, the hyperscalers, dropping over $400 billion a year on AI infrastructure. But on the other side, the actual new money coming in from enterprise AI is only around $100 billion. That's a $300 billion gap every single year. Money is pouring out way, way faster than it's coming back in.
Let's take OpenAI, right? The poster child for this entire revolution. They are, for all intents and purposes, a money furnace. They are just burning through cash at an unbelievable rate to get that incredible growth. And this isn't just a problem for startups. A wild 61% of established companies who are using AI say it's had zero impact on their earnings. Zero. And maybe the real kicker is the user conversion. For all the hype, it's estimated that only about 6% of OpenAI's massive user base are actually paying for it. It turns out building a sustainable business is really, really hard.
You know, this whole profitability gap, it leads to an even more worrying question. If the profits aren't there, what in the world is propping up these astronomical valuations? Let's take a look at some of the creative financial engineering that might be making things look a little rosier than they actually are.
Okay, you've got to understand this concept. It's called the circular financing loop. Here's how it works. A giant company, say Microsoft, invests $1 billion into a hot AI startup. The startup then immediately turns around and uses that exact same money to buy cloud services from, you guessed it, Microsoft. Microsoft then gets to book that as pure revenue. But think about it. No new money actually came into the system. It's like I give you $100 on the condition that you have to spend it at my store. It looks like I made a sale, but really, we just shuffled my money around.
And if you're getting a little bit of dot-com deja vu right now, well, you should be. This kind of vendor financing was one of the calling cards of that era. Companies like Nortel were famous for using it to juice their revenue numbers right before the whole thing came crashing down. History doesn't repeat, but it sure does rhyme, and this is a rhyme that should be a major red flag for anyone paying attention.
So, with all this hype, all this funny money flying around, how in the world can you tell what's real and what's just smoke and mirrors? Well, it means we need a new toolkit. We need to stop focusing on hype and start focusing on cold, hard metrics of actual efficiency.
In this new phase of AI, maybe the most important metric you can know is return on invested capital, or ROIC. Forget daily active users. Forget hype cycles. ROIC answers one brutally simple question. For every single dollar I put into this company, how many dollars of profit do I get back? It just cuts right through all the noise. In 2026, this is the number that is going to separate the winners from the losers.
Hey, don't worry, you don't need a PhD in finance to get this. It's actually super simple. ROIC is just the profit a company makes divided by the money that's been invested in it. That's it. While other things like return on equity are handy, ROIC gives you the clearest, cleanest picture of how well a company is actually running its business. It is the ultimate truth teller.
All right, so we've talked finance. Now let's pivot and talk about physics, because this AI revolution might feel like it's happening up in the digital cloud, but it is 100% dependent on a massive, real-world construction project. And that's where the real problems are starting to pop up.
I absolutely love this quote because it just nails it. We get so caught up talking about models and software and bits, But this is a business of atoms. It's about concrete, steel, copper wiring, water pipes, and power lines. You simply cannot code your way around the physical limitations of our planet.
And here are those physical realities. The demand for power is just astronomical. We're talking about needing enough new power by 2030 to run a country like Spain. And building a new nuclear power plant? That takes a decade, best case scenario. Then you need a colossal amount of water for cooling, often in places that are already facing droughts. And we haven't even talked about the new bottlenecks in the supply chain, like the super specialized packaging and memory that these chips need. Any one of these things could become a total showstopper for this AI build-out.
So when you add it all up, the shaky profits, the circular financing, the very real physical limits, you can't help but ask the big question, is this just the dot-com bubble all over again? Let's tackle that head on. Let's see what's the same, and more importantly, what's very, very different.
Okay, so here's the key difference. While the hype feels very similar, the financial health of today's public market leaders is like night and day compared to 2000. Back then, you had companies with no profits, tons of debt built on nothing but a promise. Today, your giants, your Microsofts, your Nvidias, have fortress balance sheets and are generating insane amounts of cash flow. And the hype is built on a technology that actually works and is out in the world, even if a lot of companies haven't figured out how to make money from it yet.
And this chart just drives that point home. At the peak of the dot-com bubble, more than a third of all public tech companies were losing money. Today, that number has been cut in half. Now, to be fair, this doesn't count the hundreds of private AI startups that are burning through venture capital like crazy. But it does mean that the public markets, the foundation of the economy, are standing on much, much more solid ground this time around.
So what does this all mean for the future? Well, it means we're heading for what people are starting to call the great AI sorting. The technology is absolutely real, but the level of spending we're seeing just isn't sustainable. A shakeout is coming. A lot of companies are not going to make it through to the other side.
And here's a tough pill to swallow. Historically, technological revolutions have actually been pretty bad investments, on average. How is that possible? Well, it's because the boom and bust cycle is so brutal. For every Amazon that emerges, there are 1,000 pets.coms that go bankrupt. All those failures drag the average return way, way down, even if the technology itself does change the world.
So how do you navigate this? Well, one way is to just diversify, buy a broad tech ETF and get a piece of the whole sector. But a more focused strategy is to go for the picks and shovels. The idea is, during a gold rush, don't bet on a single miner finding gold. Sell picks and shovels to all the miners. In AI, that means looking at the companies that enable the build-out. Companies that deal with cooling the data centers, the advanced networking gear, and, most importantly, the power infrastructure. These businesses don't care which AI model wins the war. As long as the war is being fought, they'll be selling the supplies. It's a much more durable way to invest in this revolution.
And that leaves us with this final thought. Make no mistake, the AI revolution is real. It's happening, but revolutions are messy, and they always have casualties. Being the first doesn't mean you'll be the one to last. Just ask Netscape. They literally invented the modern web browser, and when was the last time you used it? The great AI sorting will create unbelievable fortunes, but it will also create a lot of historical footnotes. The real question for 2026 is, who is going to be which?